Welcome to Larkin-Gowan Insights, accountancy and business advice for all, a series that gives you bite-sized tips and guidance on tax, funding, legislation, reforms and much more. With case studies, business advisory and sector specials and even interviews, our team of experts are committed to helping you navigate the world of accounting and finance with a variety of presenters from across our specialisms. So, let's get on with today's show.
Welcome to this edition of Larkin-Gowan's Insights. Today we are talking about stamp duty land tax, or SDLT. I'm Gillian McGill, I'm the VAT Director here at Larkin-Gowan, and I'm joined by my colleague Dominic Carter, one of the partners here at Larkin-Gowan. Dominic, you and I both know that at the time of recording in September, this has been a major issue in the press and across media. So, can you help us to understand how something as simple as a form sending in a report for stamp duty land tax can become quite so complicated?
That is a really good question, Gillian. Probably a mystery to a lot of people, how something which you would regard as a fairly straightforward thing that happens that on any purchase of a house, which most people have done at some point or another, and the solicitor sent them the form through, completed, ready for their signature or approval, and they've done that and that's gone in. It probably seemed like a really simple thing without any contention behind it. But what we do have is a really complicated system of SDLT, and I think a big problem with it, and in particular with the provisions that are engaged by the case that is currently in the media, are very, very complicated and bring ordinary taxpayers, and it could be the likes of you and me on a apparently innocuous transaction, into the realms of genuine complexity.
Where does the tax hit then? You mentioned houses. Is it just houses we're talking about?
Yeah, well, SDLT as a tax impacts acquisitions of residential and non-residential property. There are different rates for resi and non-resi. So a non-residential property is taxed at a maximum rate of SDLT of 5%. That's the rate that applies to the tranche above £250,000. Residential rates are potentially much steeper. Again, we have a tranched system with progressively increasing rates applying to the higher values. But at the absolute top end, you've got a rate of potentially 19%, which can apply. That's on the top tranche of the most valuable properties in circumstances where the higher rate on additional dwellings, which is what's in the media at the moment, applies, and where you've got a non-resident buyer. And the reason for that is there's a 5% effective surcharge for additional dwellings, and there's a 2% surcharge on the top of that for non-residents. So you've got a top rate for an ordinary purchaser of 12% right at the top end of the value chain. But then on top of that, you've got these two potential surcharges, one of which even those of us who are UK resident may well bump up again at some point in our lifetimes when we acquire a property.
Okay, so it's a slightly different way of applying tax, isn't it, to lots of others, in that we've got these kind of slabs, and the rate that applies is only to the value that's within that tranche or slab, as you've said.
That's right. I think it's actually a slice, isn't it? I think the slab system was the much maligned system that you had before that, whereby the total value of your property dictated the rate which applied to the whole transaction value. Right. So we are now sliced, and yes, it does have an element of being a bit more progressive. The more valuable the property, the more you're paying. Especially on the residential properties.
And is it simple to tell what's residential and what's non-residential? Is that just, the man on the Clapham omnibus test of we'd all know a house if we saw it?
No, it's a straightforward answer. You've got various rules that would dictate whether a property is residential. So starting point is a dwelling. Most of us would like to think we know what a dwelling is. Then you've got the garden and grounds of the dwellings that would attach to that as well. But then you've got different provisions that apply to different types of accommodation that people might live in as well. So, for example, special rules to dictate whether or not a nursing home, a care home, a prison, an educational establishment like a school, all of these things have different rules that would apply to them to dictate whether they are or are not residential. In addition, you have rules that apply to a mixed acquisition of property, which would incorporate both residential and non-residential elements, and those are generally charged at the non-residential rates. There's no apportionment between resi and non-resi in a mixed transaction, so big cliff edge there as well. So there is quite a lot of complexity. We have a peculiar rule that states that if you acquire 6 or more dwellings in one transaction, that is deemed to be a non-residential transaction. I suppose on the logic that you or I wouldn't go out and buy a house, we wouldn't buy 6 houses, we'd be some sort of property developer or property trader, and at some point it must have been felt that that merits a different treatment to buying 6 individual properties. And then one thing we have, which is also a bit of a challenge, is we have rules which link if there's more than one property that's purchased as part of one scheme, arrangement or series of transactions between the same parties, that you aggregate the values that are involved broadly, so you don't get the benefit of your 0% or whatever your lower rates are, depend on the type of land. And that was largely mitigated until fairly recently, because we had something called multiple dwellings relief, which allowed somebody buying more than one residential property to pay an amount of SDLT that was based on the average value per property, whereas now it's back to being what it was before that relief came in, based on the aggregate amount. But of course the rates are very much higher than they were back in the day when multiple dwellings relief was originally introduced.
Lots of changes then over time, lots of complexity, and one of those complex areas that you mentioned was the additional dwellings charge, and that's we think what has affected Angela Rayner's position.
It is, and the thing that surprises me really is that the piece of legislation itself hasn't come in for more criticism, if I can put it that way. As we've reflected in the past, often situations that are likely to have a complex tax analysis to them, you would like to think that in the majority of cases you would have a reasonable feel for the fact that there's going to be something complicated. You're building a 80-story tower block or something, and you're going to need some advice for that, aren't you? It's going to involve complexity. But this really, more than any piece of the SDLT legislation, is the one that has really mainstreamed some of the complexity. I remember when it came in back in 2016, there's a good deal of concern about how it was going to apply. The difficulties, potential non-compliance with it, deliberate or unwitting, and it is complicated. It simply looks at whether, the position for companies is straightforward, because it always applies to add an extra 5% onto the rate that will apply for a company purchasing residential property. So a company's position is straightforward, but the individual's position, or any non-corporate, is more difficult, because what you have to do is to say, well, at the end of the day when you complete your transaction, have you got any other dwellings other than the one you've just bought? And if you have, you will pay at the extra rate, unless you're replacing your main dwelling with another.
Right.
your main residence with another main residence. And that sounds okay, but then you get into a lot of complex rules. What's the position if I'm married and I'm buying and I don't own any other properties but my spouse does? Mm-hmm. I mean, you can probably answer most of these questions, end up with an adverse answer, the one that you most fear. What happens if I'm buying a property jointly with other people and I don't have another dwelling, but one of the 15 joint purchases in the transaction does? Mm-hmm. Again, you can imagine the answer to that. What if I'm buying in partnership? What if there's a trust involved? And I think in the high-profile media case with Angela Rayner, a trust was involved. SDLT's got complex enough provisions in relation to trusts, sometimes counterintuitive ones, but the higher rate for the additional dwellings has got its own bespoke version of who you would look at and consider whether they are the purchaser in the context of the higher rate. So you'd have one answer depending on if it was a discretionary trust, for example. You'd have another one if it was an interest in possession, when that might require you to look at a person who had an entitlement to live in the property for life and apply the analysis as though they were the purchaser. That might be different if the person with the interest for life was minor, under 18. It might be different in other circumstances. So we really do have a lot of things there that I would say you or me or the average person or indeed the average residential conveyancer might come across on a regular basis, where the rate of tax you would pay is by no means clear, or indeed in some cases the need to take supplementary advice from an SDLT specialist might not be clear. And I personally don't think it can be right that you could have such complex rules that are in the mainstream of everyday life.
That's right. From what you're saying, Dominic, to me, a lot of this is not necessarily talking about what some people might think of as unpalatable tax planning. It might well just be in the ordinary course of going about your life. For the example you gave of maybe a couple who are getting married and each have their own property and become married, they would need to perhaps take extra advice. All of these things are pretty commonplace, and we're saying, I think, that you couldn't expect those people, or indeed a conveyancer who was being paid, a fairly small amount to simply undertake the conveyancing, to understand or know what rules might apply in those scenarios.
I think that sounds absolutely fair. I mean, there are, if I can contrast it with some other rules that were brought in a few years earlier that also cause significant problems but are much more confined. If you have a company as a purchaser of so-called high-value residential property, and the cut-off is 500,000, so, back in the day, that had the effect of limiting that to properties in the London property market and perhaps genuinely high-value properties outside of London. But now, I quite regularly look in estate agents' windows and on Zoopla, and, it doesn't go as far as it did, does it? So you quite easily end up with residential property, a single dwelling, costing more than that. But that said, those rules are reserved to companies who are acquiring that type of a property with a value of more than £500,000, and there are reliefs where the company is carrying out bona fide property trades or businesses, including property rental. So I should have said what the impact of that is, which is a flat rate of 17% applied to the whole transaction, or picking up our earlier point, 19% if it's there's an overseas connection there. But that is something that you might think, well, if I'm operating through a company, I'm automatically a bit more sophisticated. I ought to know about that there might be additional rules that would apply, and I might need to take the advice. And I've got to be buying property of a certain value to be within the scope of that. And I probably will be relieved from paying that higher rate in the event that I'm carrying out some sort of bona fide business activity through the property. So I find that more palatable, but that again throws up some significant problems and can cause a very large tax liability to arise, because 17% of 500,000 is a very large amount, and a very different amount to the amount of SDLT that would be paid if those rules didn't apply. So there's complexity elsewhere, but I'd like to think you've at least got a fighting chance of knowing that there might be something complex and seeking appropriate professional advice.
And presumably then, if you were able to apply the relief in that situation, you would need to be aware of the ability to apply that relief, and your conveyancer, if you were using one, would need to be aware too, so that they could make the necessary claim within the SDLT return that was submitted.
I think that's right, yes. I suppose there is a sort of health warning here that more people tend to be investing in residential property through companies nowadays for a number of reasons. For example, there's restrictions on the income tax relief on mortgage payments to the basic rate now, but there are other reasons as well. So it might be that your average capable residential conveyancing solicitor might need to take a refresher on the when the flat rate applies and that sort of thing, because if they're presented with perhaps someone they've dealt with on property acquisitions for before, but this time they're coming through a company, in the meantime, since they last dealt with them, property values have increased. They're now looking at expanding their portfolio and buying a property that's 600,000 or 700,000. What else do they need to know? And in my mind, it should be on the conveyancer's checklist: is the purchaser a corporate? Because that's potentially going to bring into play the flat rate. But even if it doesn't do so, they will need to know to apply the 5% additional rate which we've been talking about.
So we can perhaps expect conveyancers and solicitors who are involved in land transactions to be asking even more searching questions than they have maybe done up until now, ahead of future transactions. Because it sounds
or otherwise confining themselves to dealing with an ever-decreasing number of transactions, I think. And, you might be able to avoid dealing with companies. That might be something that you say, well, I'm not going to deal with that because that's going to involve additional complexity, and it might involve a flat rate or higher rates, and I don't really want to get into that. I'm not in the business of trying to provide tax advice, but grappling with the transactions where somebody comes to you and they're just buying a house to live in, potentially. They need to know, or to be able to make a referral as appropriate, which is where we come in.
It is where we come in. So I think, in conclusion then, Dominic, it's really complicated. It's quite easy to go wrong. And the law changes all the time anyway. So if you've got your head around it one year, it might be different the next. If you are ever recommended to take specialist advice, you absolutely need to do so. And you need to come to an actual SDLT specialist like yourself or any of the other SDLT specialists at Larkin Gowan.
I completely agree with that, Gilly, but you would expect me to say that.
I would. So thank you very much, Dominic. Thank you to everybody who's tuned in to listen to this. If you want to get in touch with us, then please see the details in the show notes. Thank you.
Thank you.
Thank you for joining us for Larkin Gowan Insights, Accountancy and Business Advice for All. Don't forget, you can find more information about today's topic and more about how our team of experts can help you in your business by visiting our website, larkin-gowan.co.uk. Join us again next time for another fascinating insight into the world of accounting and finance.